Hey there, it's Dave Keller with Market Misbehavior. Today I'm going to share with you two key growth stocks showing the dreaded bearish momentum divergence. So when anyone asks me to look at a stock or ETF and bring up sort of an initial analysis, what I always bring up are three particular components on the chart: price, momentum, and relative strength. Price is important because it tells us about the behavior of investors, right? Are buyers outweighing sellers? Are sellers outweighing buyers? Is there oversized demand or oversized supply? Am I seeing fear or greed? All of those emotional and structural impacts on price are reflected in the price action itself. Momentum tells us a lot about how a stock is moving from point A to point B, because they don't just move in a straight line. You sort of get these fluctuations. And price momentum, using an indicator like RSI, can tell us a lot about the characteristics of price movements. Relative strength is important because it tells me, am I looking at the right chart? What is this chart doing relative to all the other charts I could be buying or selling at any given point? Now, as a trend is in place, and right now we have a lot of stocks in established uptrends, particularly in the growth areas of the equity markets. As prices go higher and we have a confirmed uptrend, usually toward the end of the move, we start to get some leading indicators suggesting trend exhaustion, basically implying that buyers are exhausted. There's no one left anecdotally to push the price higher. And one of the great leading indicators I like to use is called a bearish momentum divergence. Now, when price goes higher, usually is on stronger momentum or stronger positive momentum. When the price goes lower, it's usually stronger negative momentum. And that makes sense, right? When the price is going higher, more people are wanting to buy, more people are getting excited, they're accumulating shares, and as a result, the price momentum is pretty strong. And something like RSI is really calculated based on the movements, right? The up days versus the down days. In an uptrend, the up days are stronger. As a result, the momentum goes more positive, and the opposite in a downtrend. But an interesting thing happens a lot of times at the end of an uptrend, where the price keeps going higher, but the momentum, instead of going higher as well, starts to slope downwards. And that's that divergence with price going up and momentum going down. It can often indicate the latter stages of a bullish move, and a lot of times is a great leading indicator for a potential negative rotation. What's happening right now in early July is you have some of those bearish divergences. Some actually have popped up in recent weeks, but two key growth stocks, Amazon and LRCX, Lam Research, which is a key semiconductor name, both showing a bearish divergence. Before we get to the charts, if you like this sort of thinking about technical analysis and investor behavior and psychology, go ahead and subscribe to my channel. Also, give the video a like if you appreciate it. We would super appreciate that back. Put a comment below. Which stocks do you feel are most likely headed for a pullback phase, and why? Drop a comment and let me know. Now, here we're looking at a small online distributor called Amazon. I'm sure you're familiar with it, and you're familiar, of course, with the rally that we've seen in 2023, right? While the S&P, the NASDAQ, made lows in October and started to recover, you might not remember, Amazon actually made a new low going into the end of last year, so it lagged behind the market coming out of that October low. From there, though, the picture really started to turn, and you can see after the low at the end of December, we retested the 200-day moving average, pulled back and made a higher low in March, and then rotated higher. Getting above the 200-day in May, I think, was pivotal, because that suggested that we were starting to see a real rotation. After failing to eclipse the 200-day so many times, we finally got above there, and Amazon really hasn't looked back. It's continued to push higher. The momentum has been strong, and the relative strength has been improving, suggesting not only is it in an uptrend, but it's in a stronger uptrend than the average stock. Look at what happened in the month of June, though. Higher highs in price all through March, April, May, and June, and the momentum overall sloping higher until the middle of June. And all of a sudden you have what's called the bearish momentum divergence. This is where price is going higher. The momentum is actually sloping downwards. And again, that often indicates an exhaustion point. It suggests that while the trend is still higher, where we keep making higher highs and higher lows over time, the momentum behind that upswing is lessening. And again, what it's actually calculating are the moves, right? The up days and the down days over time. And it's literally looking at the average up day versus the average down day. When the momentum starts to slow down, that tells you that the up days, when the stock moves higher, it's just not as strong as it used to be. And as a result, often indicates that people are starting to take profits, so there's less optimism, less excitement about buying Amazon. Now, let's look at some examples of some bearish divergences so you can see what I mean. Well, Alphabet actually showed one of these not too long ago. If you look at mid-May to early June, you can see higher highs in price. You can see lower peaks of momentum. Now, I will tell you this. It's not the most ideal bearish divergence. For me, sort of the version that I found the most valuable is when the first, the first new high is overbought, meaning an RSI above 70. The second one is not overbought, so the RSI is a little below 70. Here, they're actually both overbought. Still a divergence, but I think it's more ideal with the example that we saw with Amazon. See, look, overbought in early June, not overbought when we make a new high in mid-June. Compare that to Alphabet, where you saw, overbought here in mid-May, also overbought in June, which is at a lower level. So still a divergence, just not the idealized version. But as you can see, Amazon's come down quite a bit. Now it's testing an ascending 50-day moving average. That's a separate video, probably thinking about the potential of Alphabet to hold. But I think that's a key chart. That's one of the FANG stocks that's really started to roll over already. Does it hold that support at an ascending 50-day moving average? Another name in the consumer discretionary space that displayed a bearish momentum divergence was Deckers Outdoor Corp, ticker DECK. It's a footwear name, kind of similar to Nike and others in that same group. You can see the bearish momentum divergence here, April and May, and the lower momentum April into May. Now, this stock did drop quite a bit. It went from around 500 down to around 425. So not a small move, but not an end of the world move. You can see it recovered pretty well. It had this nice sort of bullish engulfing pattern here at the lows, and we sort of rotate higher, and we've made new highs once again. So worth noting, just because you have a bearish divergence doesn't mean a stock's going to go to zero. It just means that this uptrend's at the very least most likely to change. At worst, could be the beginning of a significant top. And if you want really good examples of a bearish momentum divergence, look at the S&P 500 and the RSI on the S&P 500 at the 2020 top. You will see exactly what I mean with that bearish divergence. We've also had some others like NVDA recently, making new highs May into June with lower price momentum. Palantir, PLTR, which is a software name. Look at the higher highs, higher closes there into mid-June, and the bearish divergence here. Again, not ideal. I'd much rather the second one not be overbought, but still sort of fits the mold, and now we're putting in a bit of a lower high. So now that you can see what this looks like, and we showed you the example of Amazon, here's the second key name that I want to show you, key growth stock showing this bearish momentum divergence. It's LRCX. Now, Lam Research is sort of a lesser known but still a large cap name in the semiconductor groups. You probably know NVIDIA and Intel and some of those other names. This is another name in the semiconductor space, a little smaller but still a legitimate company. And as you can see, higher highs May into June, lower peaks of momentum. And I would argue, just like Amazon, this actually is a pretty clean example of a bearish divergence. Higher highs in price, lower peaks of momentum. The first one's overbought, the second one is not. So what does that mean for these two charts? Well, I would say with something like LRCX, you need to put it on a watch list, and that's what I usually do. When this sort of alert, this is a leading indicator, so the price is still going up, but it tells me there's a question mark on this uptrend. So I like to put charts like this on a watch list. On StockCharts, I bring up a chart list and I add these sort of potential topping patterns, and then I review them every day to see what sort of follow through we might get. Now, initially, what you can do is look at the 50-day moving average, look at previous price support, look at a Fibonacci analysis, taking the low and the high for some ideas about potential downside objectives. But I would say a lot of it is all about the price behavior and seeing if we get a rotation lower that breaks some sort of signal, whether it breaks a stop or breaks a particular support level that convinces you that we've actually followed through to the downside. That brings us back to the chart of Amazon. My concern with the chart of Amazon is that stocks like NVIDIA that have already rolled over, charts like Alphabet, which have pulled back to a 50-day, that might be just the beginning. Growth stocks have been leading in a big way in the first half of 2023. As we get to the second half now in July and then into August, we're going into Fed meetings. We're seeing interest rates push back to the upside, which tends to be a less ideal environment for growth stocks. A lot of these growth stocks that have been pushing higher, by many definitions, you could describe as overextended, but these bearish momentum divergence suggest to me we may be near the end stage of this rally in growth stocks, or at least the leadership, and at the very least, well overdue for a meaningful pullback. What do you think about these bearish momentum divergences? Which of these charts that I showed you do you see as the most likely to push lower, and why? Drop a comment below and let me know. For Market Misbehavior, I'm Dave Keller. Be well, stay safe. I'll talk to you again soon.